Okay, good afternoon and welcome back everyone to our Options Education webinar series. My name is Tony Zhang. I'm the Chief Strategist here at Options Play, and I am very excited to teach this particular topic that I think is very important for a lot of investors, which is the skills that are required to help grow a small options account. Now, the skills that you're going to learn here today are applicable even if you are an investor with a larger trading account. It's just that these rules around managing a small trading account are even more important when you're working with a small account, just because you have a lot smaller, you have less wiggle room, if you will, and you have a lot less room for making mistakes that you can recover from. So today what I want to do is I want to break down the strategy and the rules that I see small accounts need to abide by in order to grow your accounts. But like I said, regardless of whether you have a small account or you're working with a significantly larger account, the rules are still going to be in place regardless of your account size. So before we get started, what we're going to discuss here today is purely for education and demonstration purposes. It is not a solicitation or recommendation to buy or sell any specific securities. So we're going to start off by just giving everyone an understanding of how should I start. If you're brand new to options trading, you're trying to get started and you have a small account, where do you go about getting started? Then we'll talk a little bit about account requirements, meaning what do you need to set up with respect to your account in order to follow the things that we're going to discuss here today. And then what I'm going to do is I'm going to break down what I consider as the optimal strategy for small accounts and the best practices for trading that one particular strategy. I'm going to break down why this one strategy is so beneficial for traders with a small account. Then we're going to go through some examples because I always believe that the best way to learn is to use examples. And then we're going to show you how you can paper trade these strategies using options play. So when you're working the small account and you don't want to risk your real money at first to try things out, to test things out, you can paper trade them using options play. So we're going to walk you through that. Then I'm going to break down what I consider as the 4 rules for trading these types of strategies. These are 4 rules that you cannot break, and then hopefully show you how you can build your confidence by following the steps that we're going to lay out here from today's session. But the primary thing that I want to help investors walk away from today's session is a clear understanding as to what strategies should I focus on in order to grow a small account sustainably using options. So my name is Tony Zhang. I'm the chief strategist here at Options Play. And what I want to show you is what I have learned over the past 16 years as a market strategist working with both retail and institutional investors, and what I've learned in terms of what sets successful traders apart from everyone else, and helping you apply those rules to your account to hopefully help you jumpstart and accelerate your learning process. So before we jump into the actual lessons here today, I just want to get a quick poll here or a good sense for the audience. How many of you currently trade options? Please type yes into your chat window if you currently trade options, and please type no into the chat window, which you can see at the bottom of your screen if you are not trading options or if you're just learning how to trade options here at the moment. So yes, if you are trading, no, if you're learning or just getting started with options trading. Okay. I see mostly yeses, but now I see quite a few nos here as well. Okay, so especially if you're starting, you're more likely to be starting with a smaller account. These are the rules that are going to be applicable to hopefully help you avoid some of the beginner mistakes that a lot of investors make when they're trading options. And for those of you that have experience trading options, like I said, doesn't matter how much experience you have, doesn't matter the size of your account, the rules are all applicable to everyone. The difference is that if you have a smaller account, these rules are even more important in order for your survival of growing your options account. So let's first talk about the steps, like where do you start when you're growing a small account. And when I say growing a small account, I'm usually referring to accounts that are somewhere in the $2,000 to $5,000 range. You can trade an account less than $2,000, but you're going to find that it's almost impossible to really trade anything consistently, just because each contract that you trade is going to generally risk a significant portion of that. And that's why I find that anything under $2,000 really becomes quite difficult to get started. So if you have less than $2,000, my suggestion is to wait, build up that account, build it up until you get to above $2,000 before you trade your first option strategy. In the meantime, you can paper trade. In the meantime, you can learn. But once you have that $2,000, then you can start applying some of the strategies here today. Now, what I'm going to walk you through here are 3 steps. Number 1, gaining consistency. How can we build simple and repeatable steps that you can follow so that you can sustainably grow a small account? The second thing I want to lay out here are strategies that can help you build confidence. And these are strategies where you win more than 50% of the trades that you place. I tend to find that even if you are breaking even, meaning at the end of the day, if you're not making money per se, but you're winning more than 50% of the trades, it helps build confidence in what you're doing. It helps you want to pursue learning further about the trading and improving it so that you do become profitable. So learning how to build confidence using the strategies that we're going to discuss here today, and most importantly, for investors to continue doing something and try to grow their accounts, they need to have a clear understanding of how much they're risking and how much they can potentially make. So the strategies I'm going to lay out here today make it very clear to understand what you can potentially make, what you can potentially lose, so that you can plan out your trades. If you can plan out your trades, you have a much better chance of being successful and being sustainably able to grow your account. Does that make sense, everyone? Please type 1 into the chat window if that makes sense to you. Okay, perfect. I see a lot of 1. So let's first talk a little bit about just the requirements that you need in order to start trading options. So first, this is going to be a somewhat controversial statement here because I know many of you, especially in Canada, are trading with brokers that don't allow for this. But what you need is an options account with level 3, the ability to trade spreads. Now, some of you are trading with brokerage firms that do not allow you to trade spreads electronically. I do encourage, for those of you that do not currently have an account where you can trade spreads, to consider opening up an account with a brokerage firm that does allow you to trade spreads. Even if you maintain the most of your wealth or most of your accounts at one of these major brokerage firms, but then have a smaller account that you have your options account, these spreads are going to greatly increase your ability to trade a smaller account. When you don't have the ability to trade spreads, you really have very little flexibility in that. You have interactive brokers, you have Questrade, you also potentially have Tastyworks that's coming online here in Canada. So you do have some choice of brokers that do support multi-leg trading for both US and Canadian securities. The second thing you need to apply for is a margin account, because in Canada, these are only available in taxable accounts. So you cannot apply for a margin account in your retirement account. So this is only applicable if you're trading these in a taxable account, giving you access to a margin account. Margin is going to be required for the strategy we're going to discuss here today. And lastly, education and practice is always going to be helpful. Today, we're going to give you that education. We're going to show you how to practice, and then you're going to be able to walk away to utilize these tools to learn more, practice, so that you can become confident in trading your own account. So what I'm going to, actually, before I move on, how many of you currently trade with a brokerage firm that does not allow you to trade spreads? Please type yes if you currently trade with a firm that does not allow you to trade spreads. Okay, I see a lot of you. Okay, so again, if you want to grow your account, you have a small account and you're limited by this, I encourage you to look at other brokerage firms that do support these multi-leg trading. You can, again, keep your accounts that you currently have with those brokerage firms, but open up a small account with Questrade, with interactive brokers, and specifically an account that allows you to trade spreads with a margin account, because that's going to allow you to trade what we're going to teach you here today. So the strategy that I want to discuss is a credit spread. Some of you are familiar with this strategy, some of you are not. So I'm going to break it down, make sure everyone understands it. But this is a income generating strategy on what we call a mild directional view. And what I mean by that is that it's one of the few strategies where you can just have a loose directional view and trade. Most other strategies, you need to have a very, very clear and defined directional view before you can trade it. Example of that is buying a call option or buying a put option. Not only do you have to have a bullish or bearish view, you have to believe the stock is going to make a substantial move in the direction that you think within a set amount of time. That's the only time it makes sense to buy a call or a put. So that's a strategy that really very few scenarios warrant buying a call or a put option. Versus most of the time, you have a general sense for the trend. You might have a sense that a stock is generally trending higher or generally trending lower. And most option strategies are not suitable for that, but credit spreads are. And that's really where it comes down to. It's a strategy that's very forgiving with a higher probability of success. Like I said before, investors, when they're winning more than 50% of the time, it tends to help build confidence. It helps build the interest, if you will, to pursue learning more and improving. When you're winning more than 50%, you want to figure out, how do I win even more? How do I become more profitable? And lastly, the most important part is that credit spreads have limited risk and limited reward. So you know exactly before you get into a trade how much you can potentially make, how much you can potentially lose. And it just makes it easier for investors, especially investors with small accounts, to plan for best case, worst case scenarios and know what your potential outcomes are. Does that make sense, everyone? Please type two into the please type two into the chat window if that makes sense to you. Okay. And what I'll do is, like I said, even if you're not familiar with the strategy, we're going to dive into examples. We're going to show you these strategies so that you can learn how to trade them yourself. So I'm going to use an example here of Canadian Natural Resources. And I'm using some energy stocks because I think most investors will agree that energy is generally in an uptrend. You don't necessarily need to know where you think energy is going to be next month, but I think most investors will agree that energy is clearly on a fairly strong uptrend. And this is really where credit spreads come in, right? You don't have to necessarily time the markets very well. You could just have a loose directional view, and credit spreads are potentially suitable. So I'm going to just show you a potential credit spread here on CNQ. Going out to the August 20th expiration, I'm going to sell the $44 put for $2. I'm selling the $44 put because that's where the current price is roughly trading for. By selling the $44 put, what I'm doing is I'm collecting, in this particular case, $2 in premium. Now, for those of you that are familiar with selling puts, you know it's a strategy that you use if you want to acquire the stock. But here's a strategy that allows you to sell a put even if you don't want to acquire the stock. And many of you may know that selling a put has quite a bit of risk. If the stock were to plummet because of some news or some earnings comes out that are substantially worse than expected, the stock could drop significantly and you are on the hook for those losses. So a credit spread effectively offsets some of those losses by buying back a lower put. I apologize, this is a typo. This should say 41, not 21. So instead of selling just a naked $44 put, what we also do is we buy a $41 put. And what that does is, instead of taking on risk that looks like this, where you have unlimited risk to the downside with a short put, what you have is you basically limit your losses here to the downside. So even if CNQ were to, for whatever reason, external, macroeconomic, technical, stock sells off heavily, you have limited risk on the particular strategy. So like I was showing you here before, these types of strategies have limited gains, limited losses, a higher probability of profit that's greater than 50%, and a break-even price that's very forgiving. And I'm going to talk to you what that means, as to what it means to have a forgiving break-even price. But the net credit, what I collect here, is $1.30, which is the difference between the $2 that I've sold and the 70 cents that I have to pay for the $41 put. That difference is the credit that I receive. Now, how you look at a credit spread is important, because you really have to think of it as a trade where you're playing with the distance between the two strikes. So the distance between these two strikes, between 41 and 44, is $3. Now, when I collect $1.30 out of the $3 of the vertical spread, the rest of the vertical spread, which comes out to be $1.70, that's my max risk. So when I collect $1.30 out of a $3 wide credit spread, the $1.30 is going to be my max reward. The max risk is going to be $1.70. And my break-even price is going to be the short put option that I sold, the $44 put, minus the $1.30 that I collect. So if you take the short put minus the $1.30 that I collect, that's how you get to the break-even number, $42.70. So these three numbers are the most important numbers: the max risk, max reward, and the break-even price that we're going to discuss here on the next slide. Does that make sense to everyone, how we calculated the max risk, max reward, and the break-even price? Please type 3 into the chat window if that makes sense to you. And if this is your first time looking at these strategies, I don't expect you to follow along immediately on your first time. That's why we record these sessions. We make the slides available to you so that you can come back and review them at your own pace, and make sure you really understand these numbers before you start executing any trades in this particular strategy. So what I want to do is now I'm going to show you, if we were to sell this credit spread on CNQ, what are the possible outcomes? And that's really where we turn to the underlying chart for CNQ. So here's the chart for CNQ. Like I said, it's generally on this upward trend. You don't have to be a timer of this particular stock per se. Granted, there are better times to execute a credit spread than others, but let's just take a look at what if our general view that this stock is going to continue to drift higher is correct. What if it doesn't really drift any higher? What if it starts drifting a little lower? Or what if the stock really just starts to fall apart? We're going to look at all of those scenarios. We're going to see how this trade plays out. So first of all, whenever you sell a credit spread, as long as the stock stays above the upper strike of the credit spread, you're going to make the full $130 profit. So we talked about before, the max profit is $130. So as long as the stock stays above the strike price that you've sold, you're going to make the $130 profit. Does that make sense, everyone? Please type 4 into the chat window if that makes sense to you. That means if you get the directional view right, you're going to keep that $130 that you collected on this credit spread. Now, I would say one of the parts that a lot of investors love about this strategy is that even if the stock doesn't rise, meaning the stock does not move in the direction that you expect it to, the stock just moves sideways. Maybe it goes up a little higher, moves a lower, maybe just stays in this kind of trading range that it's been in here for the past few weeks, right? What if it just stays in this range and moves a little higher, moves a little lower, and then a few weeks later, it basically ends up at $44? Well, guess what? If it ends up at $44, meaning it doesn't move higher, it doesn't move lower, you still keep the full $130 profit. It's really one of the only few strategies where if the stock doesn't move, you make your full profits. And that's what we call a fairly forgiving strategy. But it gets actually a little better, even a little better, because if the stock drifts a little bit lower, right? So you think the stock's going to go higher, but instead the stock drifts a little bit lower between the break-even price, which we said was $42.70 and $44, you will still have a profit. You just won't have a profit as large as $130, but you still have some profit. So this is what we call the forgiving part of this strategy, right? So if the stock goes higher as you expect it to, you make the full profit. If the stock drifts sideways, you make the full profit. Even if the stock goes a little bit against you, you can still be profitable, just not as profitable. Does that make sense? Please type 5 into the chat window if that makes sense to you. Perfect. So now let's talk about what happens if the trade doesn't go in your favor. Meaning, if the stock, you think the stock is drifting higher, right? But it starts to reverse lower. It starts to break below previous support levels. You have the support level here that it broke out above from and came back to retest. But let's say the stock starts to drift lower and starts to break below these support levels. Well, as long as it stays between the break-even price of $42.70 and $41, which is the lower strike price that you purchased, what you have is a loss somewhere between $0 and $170. Remember, this strategy has a maximum loss of $170. You cannot lose more than that. So if the stock is between the lower strike price and your break-even price, you'll have some loss between $0 and $170. Now, if let's say you just outright get this wrong, maybe some news comes out that was unexpected, some earnings release came out, maybe OPEC decides to flood the markets with oil and oil crashes and this stock plummets. Well, no matter what happens, even if this stock plummets to zero, you lose $170. You don't have more losses if the stock keeps going lower and lower and lower. If the stock ends up at $41, you will lose $170. If the stock ends up at $35, you lose $170. Even if the stock goes to zero, you still only lose $170. So that just kind of is your worst case scenario. If that makes sense to you, please type 6 into the chat window. Perfect. So as you can see here, you have many scenarios where the trade is going to be profitable if you get the directional view right. If you get the directional view wrong, you will have losses. There's no doubt about that, but you do have limits to your losses to the downside if this trade just goes in the opposite direction that you had originally expected it to. So when should you use credit spreads? Well, the ideal conditions of this particular strategy are, generally speaking, when you feel that the stock is going to reverse in a specific direction. So near support or resistance levels are ideal conditions to sell a credit spread. So if you identified that a stock is trading within our trading range or support or resistance levels, when it reaches that support level, those are your opportunities to sell that credit spread, because as long as the stock changes direction and moves in the direction that you expect it to, doesn't really matter whether it moves a little bit in that direction or a lot in the direction, you'll be profitable. Same thing for resistance levels. If you think the stock is near a resistance level and you think it's going to start moving lower, doesn't matter if the stock moves significantly lower, a little bit lower, or just as long as the resistance level holds, you will be profitable. Another way investors like to use are technical indicators like overbought, oversold conditions. These are also times that you can potentially enter a credit spread. So if you want to be tactical and time these types of trades, when they're overbought and oversold, those are ideal conditions to enter them. And also trading ranges, which goes back to the support and resistance model, looking for the top of the range or the bottom of the range. But again, these are strategies that are best when you expect a small directional move. And the reason I say that is because if you really have a strong conviction that the stock is going to make an outsized move to the upside, well, in those particular cases, you're better off just buying a call option, because you're going to be able to take unlimited gains to the upside. If the stock really rallies a lot, you're going to be able to participate in that. Versus if you sold the credit spread, even if the stock rallies 200% in the next month, the maximum gain, that's all you can make, right? That $130 that we discussed here before. Even if CNQ rallies up to $100 next week, you're only going to make $130. You cannot make more than that. So just keep that in the back of your mind, right? You can sell credit spreads if you think the stock's going to make a big move, but understand you are giving up some returns by not using other strategies that do allow you to participate on that further upside in exchange for some bigger losses. So that is, generally speaking, when credit spreads are used. So let's talk a little bit about the optimal credit spread. So I've laid out the credit spread here for you, but if you were to create these credit spreads on your own, meaning a stock that you have a general bullish trend or bearish trend on, the optimal credit spread is to go out 45 days from expiration. So select an expiration that's roughly 45 days from expiration. In this particular case, we chose the August expiration because that was the expiration that was closest to 45 days. And what you want to do is you want to sell an at-the-money call or put. So you would sell puts if you're bullish, you would sell calls if you're bearish, and you want to buy back an out-of-the-money call or put against that. So roughly a 25 delta to offset the unlimited risk nature that you're taking on if you were to just outright sell the put or the call. And for traders with small accounts, the rule of thumb here is that you generally want to sell credit spreads on stocks that are priced under $50. So I'm using CNQ here for an example because it's under $50. And the rule of thumb here is that you want to collect at least 1/3 of the width. So 41 to 44 is $3 wide. what you want to collect is a minimum of 1/3 of that. So 1/3 of $3 is $1. In this particular case, we're collecting $1.30, so we're collecting more than 1/3 of the width, but that is generally speaking the bare minimum that you want to collect. If you collect less than 1/3, I'm going to show you what that means, but it really is not is a trade that you should stay away from, especially when you have a small account. When you have a small account, you only want to sell credit spreads that collect 1/3 of the width. Do these rules make sense to you? Please type 7 into the chat window if that makes sense to you. Perfect. Okay. So let's talk a little bit about these optimal credit spreads. So I'm going to give you an example here. Let's say I sell the $25 put and I buy a $20 put. So the distance between these two strikes are $5 apart. So if my goal is to collect 1/3 of the distance, 1/3 of that distance is $1.67. So if I sell a credit spread that's $5 wide, I want to collect a minimum of 1/3, which in this particular case is $1.67. Now, the reason that I tell you that you need to collect at least 1/3 of the width is because of the relationship between the income that you collect and the risk that you take. Because whatever you collect in income, the rest of it is going to be your risk. And what you want to try to do is maximize income as much as possible, because the higher the income that you collect, the smaller the risk that you're actually going to take. Does that make sense? Please type 8 into the chat window if that makes sense to you. This is a very important um, this is a very important piece of vertical spreads that investors need to understand. A vertical spread is always going to be the distance between the two strikes. Whatever you can potentially make, the rest of it is going to be risk. So you want to maximize what you can make, because that's going to minimize the amount of risk that you have to take. And what you're going to find is that sometimes you're actually going to be able to find a bit of an edge. Meaning, if you were to sell a $5 wide credit spread, instead of just collecting 1/3 of the width, occasionally you're going to be able to collect more than 1/3. So in this particular case, on a $5 wide credit spread, if I collect $2 in income, now this is something that you don't have any control over, right? Because the market is the market. You plug in the option prices tell you how much income is available. You will have to do the math yourself to see what percentage of the vertical spread am I collecting. But we tend to find that many times you are able to find some trades where you collect, let's say, 40% of the width. So in this particular case, that's $2 out of the $5 wide credit spread. Now, because I was able to maximize my income by collecting $2, I've minimized my risk now down to $3, which is only 60% of the width. So compare that to the previous slide. I risked 67% to make 33. Now I'm risking 60% to make 40. That doesn't sound like a huge shift, but in the previous slide, for every $1 I can potentially make, I was risking $2. That means if I had two winning trades for $1 and one losing trade for $2, two winning trades for $1, one losing trade for $2, basically, if I kept repeating this over and over again, I basically get myself to break even over the long run. Now, I would say for many investors, when you're starting out, if you can just break even, that's a pretty good result, because if you can win roughly 67% of the time and just break even, that's not a bad place to be as a starting point. But what you want to do as an investor is you want to move yourself closer and closer to collecting closer to 40%. Because if you collect 40% of the width, for every $3 you risk, you can potentially make two. That means for every $1 you can make, you are risking only $1.50. So if you win $1 twice and lose $1.50 once, win $2 twice, lose $1.50 once, win $2 once, lose $1.50 once, you're going to net come out as a positive. And this is the goal that you want to reach as you become more experienced, as you trade more of these strategies, and you start looking for these types of opportunities that provide you with an edge. So the goal here is that you want to sell credit spreads, you look for these types of opportunities 45 days out, you sell the at the money, you buy back a 25 delta. I'm going to show you how you can find them on options play. And you want to calculate how much am I collecting in income. So and you're going to have to do trades. You're going to have to look at trades all the time. Some trades are going to collect less than a third, some trades are going to collect more than a third, and what you really want to find are the ones that collect more than 1/3, because that means that the option market is giving you a slight edge and you want to take that edge in your favor. Does that make sense? Please type 9 into the chat window if that makes sense to you. So let's talk now. I think what I should do is, at this point, I want to take a pause here and I want to look at some real examples, because I think we've done enough learning here, and I think it's important that we spend a bit of time to look at some real examples, because that's going to help you solidify what you've learned here today. And I want to show you how you can practice trading these types of strategies, because it's one thing to learn, it's a whole nother thing to apply. So I always want to try to help you apply as much as possible before we jump into trading these types of strategies. So again, let's go into CNQ, right? This is the trade that we were looking at earlier. And if we were to set up a vertical spread, you can click on modify for any strategy, and you can use our strategy constructor. So if you're bullish, you're looking for a short put vertical. If you're bearish, you can look for a bearish short call vertical. We'll look at both just to show you how to set them up. And then what we're going to do is we're going to modify them. Like I said, you want to roughly have 45 days. So the September expiration is 65 days. That's a little too far out. The August 20th is 37 days. That's suitable here. Now, CNQ has declined here since I put together these slides. It's now down to 43. So let's now go back to selling the 43 strike put. And then we're going to buy back roughly the 25 deltas. So if you look at the strike price, there's 3 numbers. You have your strike price, you have your premium, and then you have your delta. So as you see, the closest delta here to 25 is the 40 delta. So what I'm going to do is I'm going to sell the 43, I'm going to buy back the 40. And when I look at this currently, based on the current price, collects exactly $1. So it's a $3 wide credit spread, and I'm collecting exactly $1. In this particular case, you don't really have an edge, but this is a trade that I think is perfectly reasonable for an investor to take when they have a generally bullish view here on CNQ. Does that make sense? Please type a 1 into the chat window if that makes sense to you. This particular trade no longer provides an edge like the one that I was showing you earlier, but this is one that is perfectly reasonable to trade. Now, if let's say this collects less than a $1, then that's one that you want to stay away from. But let's talk a little bit about how you can paper trade this, because you can click on this blue share button on any strategy that you view here in options play. And when you click on that blue share button, when you click on the blue share button, you have the option to paper trade the trade by clicking on this link button. When you click on this link button, what happens is we basically save the trade for your portfolio into your account or into your profile. And you can go to your profile by clicking on your name in the upper right-hand corner. When you click on profile, you're going to see a section here that's called share trades. Now, I actually don't have this enabled on my account, but you should be able to go to share trades and see the individual trades that you have. So here's the CNQ trade that I have. I just created this trade, and you have both a share link and a URL link. This is effectively your ability to paper trade these accounts or these trades, because when you click on the share link, what it's going to do, it's going to reconstruct the strategy that you paper traded. And what it's going to do is actually going to calculate the P&L of the trade since you've entered this trade. Now, because I've entered this trade just a minute ago, the P&L on this particular trade is 0. But for those of you that want to track this over a period of time, you want to come back tomorrow, you want to come back a week from today, you want to see how this trade is performed, this is one way for you to just get started with trading without risking your real capital. So again, just to reiterate, for any symbol that you type in, any strategy that you look using options play, what you're going to be able to do is click on the blue share button, and then click on the paper trade link, and that's going to save these trades into your profile. Once you have those trades saved in your profile, you can always go back and look at those paper trades, track how they've been doing, and it's going to be a great way for investors who are just starting out to learn more about these strategies without risking real capital. So let's talk about the 4 rules that I have seen over the past 15 years that lead to more sustainable growth of an account based on the work that I've done with institutional and retail traders. And it all comes down to how you manage your trades. So the first rule is to never enter credits is to enter credit spreads that collect at least 1/3 of the width. If you're collecting less than 1/3 of the width, the risk to reward is skewed against you. You never want to risk more than $2 for every $1 you can potentially make. So you can avoid that by making sure that you're collecting at least 1/3 of the width. The 3 next rules that we have here are for managing this trade. So once you've sold the credit spread, how do you decide when to get out of the trade? Well, there are 3 possible triggers that generate an alert to close out an existing credit spread. There is a take profit order, there's a stop loss order, and there's also a time-based trigger. So the first order is a take profit order. You want to take profits at 50% of the max gain. I'm going to go through an example of this. You want to set a stop loss at 100% of the max gain. And if the trade gets to 21 days to expiration and your stop loss order and your take profit order has not triggered, it's also time to close out the trade. You can potentially roll the trade into another 45-day option, but you generally never want to hold these credit spreads within the last 3 weeks. If you hold them in the last 3 weeks, you have risk of early assignment. That means the short leg is assigned and you're either long or short the stock. That's not something you necessarily want to do. You can end up getting a margin call if you do get assigned that stock. So all things that we have here, all these 3 rules are designed to help avoid that early assignment. So as an example, if I sold a $5 wide credit spread and I collected $2 for it. So in this particular example, I'm collecting 40% of the width because $2 out of $5 is 40%. What I want to do is I want to put in an order to take profits at $1 because that is half of the max profit that I can potentially make. If I sold something for $2 and I can buy it back for $1, my profit is $1. That's half of the max profit. I also want to set a stop loss at $4 because if I sold something for $2 and I have to buy it back for $4, that's a total loss of $2, which is my max profit, 100% of my max profit. And then again, if I get to 21 days to expiration and my stop loss order or my take profit order has not triggered yet, it's also time to get out of this trade. So those are the 4 rules that you have to apply to your trading account in order to sustainably grow your credit spreads or sustainably grow your options account using credit spreads. These rules are not difficult. They are maybe tricky for the first time users, but once you get used to them and place them a few times, they become mechanical. And the rules are meant to be mechanical so that you can remove the emotions from trading. Trading shouldn't, and I know it's very difficult to remove the emotions from being right or wrong, from losing money and winning money, but if you're able to make mechanical rules, that's when you have the best shot of potentially removing as much emotion from the decision-making process of entering and exit trades. It should be more of a mathematical probability-based approach as to what you do in each scenario, whether you stay in the trade, whether you exit the trade. They should not be based on emotions. They should not be based on where you think the markets are going. It should be based in math. And that's what these rules are here for you to do. And lastly, the most important part in helping you build your confidence, if you listen to everything that I taught you here today, but you don't listen to this last part, I can almost guarantee that you will not be able to sustainably grow your small account. And this is what we call the golden rule of risk management, the golden rule of trading. And this is one of the things that if you look at professional traders or traders who trade for a living, this is the one rule that is absolutely unbreakable. Everything else you have different levels of flexibility on. That if you have, a view on the markets, that you have some flexibility on when you take profits, when you cut your losses, how long you stay into a trade for, especially if you have some experience. But the one rule that there's no flexibility on is what we call the golden rule of risk management, which tells you or dictates to you the maximum risk you can take on an individual trade. And these numbers may look small, especially when you have a small account, but these are even more important when you have a small account. And the rule of thumb is that the max risk of a credit spread should never exceed 1 to 2% of your total portfolio value. If the trades that you make, the max risk on them exceed these thresholds, what you're going to find is that you're going to have sometime throughout the year, a bad month in the markets, a bad string of trades that's going to blow a huge hole in your portfolio. And those are difficult to come back from. So if you want to build your confidence, you want to grow your account sustainably, what's more important than winning and losing is making sure you don't blow up your account. Because the second you blow up your account, game over. You can't trade anymore unless you deposit more money. And that's why you want to make sure at all costs you do everything you can to prevent that account blow up. And there's one trick that you can make, one rule that can effectively force you to not blow up your account. And that's sticking to the golden rule of risk management. So if you look at your account, let's say you have a $4,500 account. That means the maximum you can risk on any given trade is $90. It's not a lot, but if you use the credit spreads and you stick to lower price stocks, you may not find these trades every day, but you can find trades where your maximum risk is somewhere in the $90 range. I do tend to find that for some investors with a very small account, you may find that you have to move to 3%. But the rule of thumb here is not necessarily that you have to stick to 2%, but the fact that you stick to some number that's relatively in this threshold level that allows you to maintain your risk. Because even if you risk 3% of your account per trade, and you have 5 losing trades in a row, which sounds like a death sentence for a lot of investors. A lot of investors, when they have 5, 6, 7 losing trades in a row, they think to themselves, "I'm really terrible at trading. My indicators really suck. My strategy sucks." Or whoever I'm following that I think is smart and I think they know about the markets, they must be terrible at it. And I cannot tell investors how. Think about flipping a coin. There are just over thousands of opportunities. There's going to be some times where you have 7, 8, 9, 10 losing trades in a row. They don't happen very often, but they do happen. There's nothing you can do to prevent that. So what you have to prevent is that when those string of losses occur, and you don't know when that's going to occur, but when they do occur, you want to make sure that that doesn't blow up your account. So if you stick to the 2 to 3% rule, that's going to effectively force you so that even if you have 10 losing trades in a row, you still have 70 to 80% of your account intact to continue trading. But if you risk 10% of your account per trade, even if that string of 10 consecutive losses only happens once every 2 to 3 years, every single 2 to 3 years, you're going to effectively blow up your entire account and you're not going to be able to continue trading. That's why this is the most important rule. Even if you don't follow any of the previous rules I showed you before, this is the one rule that if you don't follow, you will almost guaranteed at some point in your trading career, you will blow up your trading account. Does that make sense? Please type 2 into the chat window if that makes sense to you. So that is what I wanted to that's what I wanted to show you here today, is the strategy that you would need, credit spreads, the optimal credit spreads that you can try to find in this market when you have a directional view, using that 45-day, selling the at the money, buying back the 25 delta, and trying to collect at least 1/3 of the width. And the rules that you want to apply once you're in those trades to decide when do you get out of those trades. And then lastly, the golden rule of risk management. If you were able to utilize all of these rules that I discussed here today, you have a fair shot at helping you grow your small trading account sustainably. And the last thing I will say is that you generally don't want to have more than 5 open trades at once. Not, the 1 to 2% rule is generally designed so that if you have more than 5 open trades at once, you need to start moving down into the spectrum. So if you want to have more trades on, you can. You just have to risk even less as a percentage per trade. That is really the summary of what I wanted to show you here today. So trade simple and trade small. Credit spreads are fairly simple strategies. They may take a little bit of time to get used to and to learn them, but once you learn them, you'll see they're simple. You know exactly how much you can make or lose. And if you stick to the 2% rule, that's going to allow you to stay small. That's going to allow you to survive, unprofitable periods of trading, and then having an edge. Always try to collect closer to 40% of the vertical width, and learning how to read charts will also be important, because that's going to help better your timing, right? Like I said, you can sell credit spreads all the time, but if you can time the markets, that's when you're going to increase your probability of success. And lastly, practice, practice, practice. Paper trade using options play, trade often. That's how you're going to be able to learn to apply, what you've learned in the overall markets. So with that, that covers what I wanted to share with you here today. I hope that this was helpful in giving you a better understanding of how to grow a trading account sustainably using one simple strategy. Like I said, even if you don't have a small account, even if you have a very large account, even if you're very experienced, all the rules that I showed you here today are still applicable. It's just that when you're working with a small account, these rules are more important. So with that, thank you so much. I hope you guys have found this particularly useful for your trading and for your education. At this point, what I'll open this up is for Q&A for a few minutes, and I'll try to answer a few questions before we sign off here for today. So first question is, please explain how to close a spread at gain or loss, and when do you need to close? So I've talked about when you need to close. As far as how do you close, that's a question that you should point that question to your broker. Each broker has different, I would say, functionalities built into their platform that allow you to select an existing position and enter an order to close it. So please ask your broker as to how they can help you with that. But Tony, 1/3 of the width sometimes mean your strike price is so close to the stock price that you really have to be accurate on the direction. Risky? No. So I don't know what you mean by risky. You know exactly how much you're risking on a particular trade. So I'm not sure what you mean by risky, right? So in this particular case, I've sold the credit spread that's exactly at the price of the underlying stock, and I'm risking exactly $170. So uh, you know risky or not, you know exactly how much you want to risk, how much you're willing to risk. And like I said, what you're effectively suggesting is that if you sold a credit spread that was down here, it's somehow less risky, because even if the stock declines, you're going to be able to be profitable. But I'm going to tell you that's even more risky, because if you sell an out of the money credit spread, for every $1 you collect, you're not going to be risking $2. You're going to be risking $3 or $4. So yes, you are taking on less risk, but if that trade works out against you, you're actually taking on substantially more risk. So I would argue that selling credit spreads that are very close to the current price is actually less risk than selling out of the money credit spreads, because don't confuse probability with risk. What you're suggesting is that trades that have a higher probability of success, and you're absolutely right. When you sell something that collects less than 1/3 of the width, you have a higher probability of success, but you're actually taking on more risk. You have to think of risk in the terms of my reward, right? For every dollar you can potentially make, how much are you making, or how much are you risking? If you collect 1/3 of the width, then you're risking $2. If you collect less than 1/3 of the width, you're risking more than $2 for every $1 you can potentially make. And that is the equation that's going to hurt you in the long run. Why do you consider that 45 days expiration to be more appropriate? That's, Sergio, purely based on backtesting these strategies. We have backtested it across just about every single possible expiration date on these types of strategies, and 45 days clearly in the long run provides the highest returns. Do you have a rule of thumb for when to sell straight call options that are in the money? I don't recommend anyone selling any type of in the money option because first of all, selling options is you're trying to take advantage of elevated implied volatility. You're trying to take advantage of time premium. When you sell an in the money option, you're not selling as much time premium, because intrinsic value of an option never erodes. As an option seller, you want the full value of the option to erode. So that's why we never ever recommend selling in the money options, always sell an out of the money option. We never collect the max gain. That's correct. We never collect the max gain, but we also never have the max loss. And the reason for this, it's not that you can't collect the max gain. It's just that when you collect the max gain, you're also putting yourself at early assignment risk and exercise risk. And we tend to find that in the long run, removing early assignment and exercise risk is more beneficial than trying to collect the rest of the max gain. Hi, Tony. What is going to happen if your long put leg gets auto exercise? Well, you can't get auto exercise on a long put because the short put must be exercised as well in that particular case, right? Because you sold the 44. If the 41 is auto exercise, that means the stock is below 41, which means that you also can exercise your $44 put. So I'm sorry, the 44 put will also be assigned to you. So if you ever have auto assignment, first of all, that means that your short leg will also be assigned, but also Glacier, the reason that will never happen if you follow these rules is because we never hold these to expiration. You always close out this trade either at this level, or this level. All three rules are designed to completely avoid that scenario that you just laid out. Raymond, thank you so much. I really appreciate it. Canadian have to pay ridiculous option commissions that make it very costly to do multi-leg trades versus very inexpensive contracts. Well, I can't tell you enough. The interactive brokers is significantly lower cost than some of the higher price brokerage firms in Canada. Same thing with Questrade. It's a little bit more expensive, but certainly still what I consider fairly competitive. And yes, TastyWorks is coming to Canada soon. More profitable to enter near the support than resistance. Gene, there is some evidence that short put credit spreads have a higher probability of success than call credit spreads near resistance. And that's simply because markets drift higher over the long run. You have a higher probability of markets moving higher than they are to move lower. So call credit spreads will be less profitable, but they also can collect higher premiums. So they kind of offset each other to some degree. So I wouldn't necessarily say one is better than the other, but certainly there is a higher probability of success selling put credit spreads than there is for selling call credit spreads. So you do this with a 45-day expiration, but reverse before 45 minus 21. I'm not sure what you mean by reverse. If by reverse you mean exit the position, then yes, you exit the position at 21 days to expiration if the stop loss or the take profit has not triggered yet. Is there a source for determining IV? Your brokerage firm should be able to show you IV on your options chain. Anil, Tony, is it better to close or roll a position within 21 days to expire for index credit spreads? So index credit spreads, because index options remove early assignment and exercise risk, you don't have to follow the same rules for index options. Index options do make the management of these strategies a little bit easier because both the take profit and the 21-day rule is effectively optional. But I will say index options, you generally will find that you're not able to collect 1/3 of the width. With that, that covers the questions that I have time for here today. I really hope that this was helpful in giving you a better understanding as to the strategies and rules around how you can sustainably grow a small account. And I really encourage for those of you that are options traders today to take the time to review what you've learned here today, apply them using practice paper trades at first if you're new to these types of strategies. And if you're brand new to options trading, go back and review this session. I don't expect you to be able to digest everything that I just spoke about here over the last 45 minutes on the first attempt. Go back, watch the recording, download the slides, learn at your own pace, go through some examples, follow the CNQ example I showed you, find your own examples, see that you're able to follow these steps over and over again using a paper trading account before you trade your first live account. Once you do that, please make sure that you follow that golden rule of risk management. Never exceed more than 1 to 2% of your account per trade. If you do, you're likely going to see scenarios where you do potentially blow a large hole in your portfolio at some point over the next 6 months, 1 year, 2 years or so. It may not happen initially, but it will happen at some point. So you want to make sure that when that string of losses occur, and every single trader will tell you at some point it will occur. You just don't know when, you don't know how, but it will occur. And your goal as a trader is to make sure that those string of losses do not blow such a large hole in your portfolio that you've blown up your account and you don't have any funds to continue trading unless you deposit more money. Most experienced traders have gone through some version of that. And if you can relate to that, hopefully that makes it even more convincing as to why you need to follow these rules, especially that golden rule of risk management. So with that, thank you so much. Have a great trading day. We will send you an email with the recording to everyone who is registered to this session here today. Have a great day, and I'll see you guys here in in less than 2 weeks time on our next options education session. Have a great night.